In today's video, I'm going to be talking about whether or not housing is fundamentally a bubble. Now, filming this video makes me feel like a bit of a loony, if you will. What kind of person walks around with their phone out, talking to themselves with the hopes that someone on the internet will be watching? Now, the reason why I'm walking is because currently I'm getting my car serviced. So whilst I'm waiting, I went to get some delicious lunch. I had a roast chicken, potato and gravy, and vegetables, hot meal prepared for $7. Now that's a pretty bloody good deal if you ask me. Now on the best of days, I feel anxious at home with the prospect of talking to myself and uploading it to the video, let alone walking around outside, pointing the camera up and talking to myself out loud effectively. The issue of whether or not housing is a bubble is something that I've thought about for a very, very long time. And the more I have thought about it, the more prices have typically gone up, especially during COVID. I remember researching the housing market as far back as 2016 and being like, wow, how can anyone afford that? Well, now I look at prices from 2016 and I think, if only we could go back to that. So you have to wonder if now is a similar situation where more inflation is built into the market, and that in a few years' time we're going to be wishing that we went back to 2024 prices or 2022 prices, 2021 prices. There's quite a few ways to think about whether or not housing is way too expensive. You can consider it from the perspective of an owner-occupier or an investor. Depending on where you stand and what your intention is, how you value the market and where its fundamentals lay ultimately differs depending on which way you are wanting to look at it. I believe that for investors, the equation is fundamentally rubbish. But whereas with owner-occupier homeowners, the numbers do look a little bit better. Even then, it's still not great. To give some context, where I live in Auckland, New Zealand, the average house price is about 1.2 million currently as of recording, as of 2024, I believe. During the peak of the market, it went up to 1.5 mil, but since interest rates have increased, there has been a retractment in house prices. After you account for inflation, in real terms, house prices are back to where they were in 2015, but nominally, they are still ahead of what they were, having no real increase in 10 years. Depending on where you stand on what property is, it's either a conservative investment, it's high growth but safe, or it's about asset protection, or it's about protecting against inflation like gold, a currency hedge if you will. But whether or not you value property as something high risk, high return, or a conservative hedge, that's completely subjective, and there's no real authoritative source on whether or not that asset class or property is either or. It does raise the interesting question of, if it is meant to be a currency hedge, why then should it experience rapid growth? If it is about protecting the value of your dollars, inflation has not been 7% throughout the 2010s. It's been at times 0% in the case in New Zealand, especially around 2015. Yet property has still managed to shoot ahead. Only in the last 4 years have we experienced consistent 7% inflation, but even that's coming down now. Fundamentally, property can't be all those things at once. It can't be safe, high return, or a currency hedge. It's just not possible for it to be all three of those things. Another question to ask is, What is property meant to represent for owner-occupiers? Are you intending to buy a property because you're looking to save on rent in the future? Or perhaps you're even looking to save on costs now, and the equation is such that renting is more expensive than owning comparatively. How many years of today's rent then, as a multiplier of house prices, is an acceptable amount to pay? Currently in Auckland, the average house is 1.2 million, as I previously said, but rent at the moment is about $650 a week, so around 32,000 a year approximately. I don't have my computer with me, so I'm just spitballing these figures. Is it acceptable to pay the equivalent of 25 times rent in 1 year before interest costs are accounted for, where the mortgage can be sometimes double depending on the interest rate, the principal? So the total amount with interest gets up to an extraordinary amount. The traditional argument for home owners to buy a property compared to renting is that by buying they're going to eventually save on rental cost. But the numbers are such now that it just doesn't make sense. Now, a good argument I have heard is that you're paying for today's rent and not having to pay what rent will be in 30 years' time. It's completely legitimate, but now it's become a question of opportunity cost. Is it worth buying a house with the hopes that the returns of not having to pay rent in the future is worth it, versus not renting and investing in an alternative asset class? Admittedly, as someone who thinks property is overvalued, there is still, at these valuations, a justification for investing in property for yourself as a homeowner. Eventually rent will go up, that's just a fact of life. But if your goal is explicitly for an investment, then it is not the best investment, as I will explain. Ultimately, an investor should pride themselves on being able to do a comparison, to work out their arithmetic, to determine whether or not the numbers make sense. But I don't see a lot of that fundamental investing mindset with housing investors. Not to the extent that you would see with stocks or business, for comparison. Housing is the only asset where people will look at the numbers and determine that making a loss, a cash flow loss, is perfectly acceptable, whereas with any other business or investment, they would be scrambling to escape. Property investors have given a special term to making a loss. They call it negative gearing, and it's apparently a strategy. It's okay to make a loss, a cash flow loss, because the appreciation in capital gain will offset that and it'll be well worth it in a few decades' time. Now, that's perfectly fine, but in any other business, if property is to be treated like any other business, investors would be running for the doors. The way you would traditionally determine the value of a business is by something called the PE ratio, price to earnings ratio, earnings being profit. How many years of earnings would you be willing to pay for a stock? That's fundamentally the equation. So, for example, something that makes a 3% profit is a PE multiplier of 33. Now, that's just an example, but more traditional businesses, established businesses, companies like Coca-Cola, for example, they tend to have quite a high PE ratio of about 20. I just made that up for context. Something more speculative, like Tesla, for example, greatly overvalued on the stock market, despite what YouTube so-called investors seem to think, might be trading at a valuation of 200 times earnings. Now, the trouble with property for investors is that if they are using this PE ratio, then there is fundamentally no E. There are no earnings. This means that if you are to buy the average priced house and rent it out for average market rates, your cost would greatly exceed the income derived from the property. You'd be running at a net loss. Currently, based on my valuations for the Auckland market, this is to the tune of 30 grand a year. With today's interest rates, it is. So the average house is making a loss. You would be better off putting it into a bank term deposit, making 5%, and you would be richer than a property investor. The average property investor will respond and say, but the 3% loss doesn't matter because that's offset by a gain. A capital gain, property appreciation of around 7% per year, which has been the average for New Zealand for the last 30 years. Now that is true, but even then, with a 3% loss, that's still only a net gain of 4%. So it's still below that of a savings account. Now, like the homeowner example where the goal is to save on rent in a few years' time, that's all well and good expecting property for income in a few years' time, but then that still gets back to the question of opportunity cost and whether or not it is worth buying a property or investing in an alternative asset class. Going back through the past 30 years and looking at the average rental yield to price, in the 90s it was around 4.5% and now it's below 3%. So property has also, in major cities, never been about having a cash flow yield as such in the initial years. So perhaps my argument is completely moot about things like cash flow mattering at all, when for the last 30 years the expectation has been for capital growth. On the other hand, you have to question whether or not just because a bubble gets bigger and bigger does not make the earlier point not a bubble either. It does seem as though fundamentals, even if you can muster up something that makes sense, fundamentally it's just a subjective perspective. It may not be the core objective factor that is driving the property market, and that may well be the case as to why cash flow investing in major cities just doesn't matter. So as right as I could be, I may be completely wrong by determination of the market. At the end of the day, it does seem as though with property investing, people do take a lot more liberties and give a lot more leeway for what amounts to a traditional failure or loss compared to other business. We are at a point now where reverting to a system where cash flow and PE ratios for property matters would completely disrupt the global system. And it's not in the psychology of property investors, the ones who drive the market, nor property homeowners. Ultimately, they're the ones with the money, they're the ones driving the market, they're the ones bidding up the price. If you're not invested in property, not buying really doesn't matter because someone else will. As long as nothing changes politically, the expectation is clear, the psychology is set in motion by far. Ultimately, property will continue to grow. Things like cash flow will only continue to shrink relative to the price of property. Unless there's complete disruption to credit, supply of housing, or laws governing how property investing works, which will never happen, then what's the point? You might as well look at the reality and the history as it is. Being correct and putting your objectives, what you perceive to be objectives, ahead may, at the end of the day, be the thing that makes you lose money. I'm a complete cynic that things will get better when in relation to property. Ultimately, the environmental movement is only growing. Globalization and migration, which is a good thing, is a recurring theme, and nothing will change there. It's only going to keep accelerating. In a sense, if migration were allowed to continue had borders not closed during coronavirus, then we're still below what the forecast would have been using previous trend figures. Ultimately, it's up to you what you want to do. This is only some of my thoughts as to what I believe about property. I don't own any property, regrettably, and I would like to buy some, but it's just not in my life path at the moment. Thank you very much for watching. If you enjoyed my analysis, please comment, like, and subscribe.